GameStop reported earnings yesterday after the bell, and shares are falling more than 18% today after the company missed on a top and bottom line. The only positive in that is the fact that e-commerce sales did jump 175% last quarter and accounted for more than a third of the sales of the company. Now, we want to go ahead and break down these earnings quick. The company reported $1.34 per share and had revenue of $2.12 billion. Wall Street was expecting $1.35, so they missed it by 1 cent on that. And they were expecting revenue of $2.21 billion, so they missed it a little bit on that as well. Some of the things to break down that was said is that the company did shake up their executive role a little bit. The company named former Amazon and Google executive Jenna Owens as their new COO. Also, in a hint of the transformation, some investors got excited about the stock. But like I said, the e-commerce was up 175%, and maybe that will push management more to be more inclined to transferring from a brick and mortar business model to a more e-commerce, e-centric business model. The company unfortunately did acknowledge that in a filing they considered selling additional equity shares to fund its transformation. So in the short term, that is an issue because obviously if you're adding more shares to the market, you're diluting the current shares out there, thus making them valued much less than they currently are. But in the long term, that could be seen as a big positive. The fact that they are innovating and ready to change what they are doing to a more e-commerce play. The company in the earnings call actually had a max capacity of people in the call itself, but the company declined to answer any of the questions, which people were a little annoyed about. And the company also didn't give any guidance for next quarter, which a lot of people were very upset about. They were hoping that the company would come out and say, we're expecting to do a lot more revenue, a lot more earnings next quarter. But the company failed to do so with that. Failed to talk about Ryan Cohen and his transformation, potentially taking over and, really running this company into a more e-commerce play. But if we go ahead and look at how the stock is trading as of right now, as you can clearly see, the stock is down about 18% to about $149 a share. It was down much more earlier. If we do go ahead and look at the chart, it was down significantly more, around 21%, but it's having a bit of a recovery now. So I'm actually curious to see what's going to happen with this at the end of the day. We're seeing a lot of volatility in the market from all sectors. You have tech stocks again being sold off very hard, with Jay Powell speaking right now and talking about different things like inflation, the yields, what's happening in the economy, unemployment, all those issues in the market right now. But one of the big things that bodes well for GameStop is the future of e-commerce and the future of gaming. If we go ahead and look at gaming in the US alone, it's growing at a very, very high rate, exponentially. And especially as we continue to grow and get more digitalized, the video game market is only going to grow. The game market was valued at $151 billion in 2019 and was around $179 billion in 2020. And obviously it was even more than that after the pandemic hit and people went all back inside their houses, back online. That really amplified gaming. And we see the same thing with e-commerce as well. E-commerce is only growing, and it's only going to continue to grow and grow more and more as time goes on. We're seeing global e-commerce just grow at exponential levels, and we're going to continue to see that as well. People leading the way like Amazon, Shopify, and we're just going to continue to see these trends more and more. And I think this bodes well for GameStop if they do transition to a more e-commerce role. Now, I didn't want to report right after the bell yesterday because, as you guys know, in after hours, the company was actually up after they reported earnings. The company hit $199 in after hours, and then about 15 to 20 minutes later, the stock was then down 6%. So it's just extreme volatility right now, and a lot of option traders are getting burned really badly. If we look at some of these options, these things are down huge amounts today, and that's normal. We had a really, really bad earnings call, and these stocks are just getting absolutely slaughtered today. But the one positive that came out of all of that was the potential for this e-commerce play and showing that e-commerce sales were up 175%. So I mean, the implied volatility is just absolutely insane right now. 386% for the 52-week implied volatility. Current volatility is currently at 100%. So obviously there is a lot of IV behind these. But I mean, if we go ahead and look at some of these other ones, the calls are getting absolutely slaughtered today. And that's called IV crush after earnings. If things don't go your way, these things get IV crushed. The options are up a little bit, but as you can clearly see, not by much. And the calls are just down, huge amounts, over 50%, 65% on some of them. So, you have a bad earnings quarter, and that's what happens. But the future of GameStop really depends on what management is going to do, and if management is going to be more transparent about guidance in the future and what they plan on doing with Ryan Cohen, with the e-commerce platform, and what they're going to do about all these brick and mortar stores that are just all over the place, swallowing up the company's cash flow, and essentially just having them have to use more debt, because that's obviously a big issue for the company is their debt. And we see this, and you wonder how a company can get out of the way, how a company can thrive if they don't change. And that's exactly what's going to happen. And that's why you see so many bears out there, because it's a company failing to innovate. And they're expecting on the downfall that the management is going to be incompetent in changing that, or unwilling to, and you're going to see a bit of a crash. So I'm hoping that things change for it, because for people who are invested in, obviously, a lot of you guys, I don't want you guys losing a bunch of money, but the chart is a little alarming. Obviously, we look at the run that GameStop has had, and it's absolutely incredible when you really zoom out and look at it. You see a run from $15 up to $500, and then it goes right back down to like $39, and now is back up to $148. Like, there is just so much volatility in this stock, and you just have to be careful with that. If you're playing the short term, because if you predict wrong, if you buy a call on the wrong day, the implied volatility is so high on these options that you can end up just getting absolutely slaughtered. Even if you go long term out, you go to a bunch of months out, even in July, and you want to buy a call, you could still get slaughtered on some of these calls, even if you buy the 150 call. If we analyze this a little bit and really look at it, it gets ugly quickly if you don't time this perfectly. It's the sad truth, unfortunately, that if you don't time these things right with extreme volatility and implied volatility like we have, you can just get IV crushed. Very, very difficult. So I think your best bet, honestly, is to sell a put. If you're bullish on it, either buy equity, buy shares, or sell a put. And if you're bearish, I recommend selling a call. Just because you're buying something with such an implied volatility, if it doesn't have that big move, you're screwed. Like, you are completely screwed on that play. So it's just not worth the risk of buying a put and potentially just getting absolutely destroyed on one of these plays. So that would be your best bet, is to probably sell a put, take advantage of the high implied volatility, and make money that way, rather than trying to time it perfectly with buying a call or buying a put. You have one bad day, and next thing you know, you just get completely IV crushed. So as you can clearly see, like, the chart obviously has gone down in implied volatility recently after earnings, but even a couple of days ago, this thing was super high. But you buy the implied volatility in the next couple of days, your implied volatility is insane. 300% implied volatility, even up to April 9th. So you want to reduce your risk a little bit. You can go more out of the money, more at the money, and more longer term. But if you want to be an option trader, I would take advantage of selling some of these premiums. You look at this right here. That's insane. That's insane IV. And, E-Trade's a great way to look at some of this stuff and to look at, some of the different plays with that. So you can even build different strategies. You can, pick 100 and something strike price and look at, the possible scenarios, what you can buy, what you can lose. So it's pretty interesting that way to really break it down and look at it. But like I said, I really recommend just, if you're going to do something, sell it. Sell the option. Take advantage of that just insane implied volatility on this stock. Because if you buy calls or buy puts, like I said, you can get slaughtered pretty quickly. So that'd be my strategy. If I was looking to put a position into GameStop right now, I would probably go out to about July, maybe even May actually. I'd go down here and I would sell the 125 put. So right here, I would collect $4,000 in premium to say that I'd buy the stock at 125. Or if you want to be more short term, you can even do something like next week, next Friday. You could say I want to do the 140 strike price, sell the put, get paid $2,160 to buy the shares if it goes under 141. I think it's your better bet than just buying the shares outright, or obviously buying a call and the stock doesn't do anything and you get IV crushed in the next couple of days. So that's just what my strategy would be. That's what I would personally do. But again, I'm not a financial advisor at all. And all trades have risks, obviously, because if the stock crashes hard, you're screwed either way. But at least you get paid some premium to buy the shares at a lower price. But that's just one of those things where you have to time these things right if you're going to play the options short term. And after a bit of a sketchy earnings call, we could definitely see some downside if CEO goes ahead and offers more shares out, obviously causing dilution in the stock to go down. But obviously if news gets around that they're really trying to transform the company to a more e-commerce play, you can see the stock absolutely soar. So again, it's a high risk, high reward type play, and just be cautionate with that. So hope you guys enjoyed this video. If you did, make sure you like and subscribe, and I will talk to you guys in the next video. Bye.